Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com. Now over to your host, Sparta co-founder and CEO, Felipe Sherman.
Welcome everybody to a new episode of the Sparta Market Outlook. Today I'm joined by Philip Jones-Lux. Hi Phil, how are you?
Good, thank you. Good morning.
Morning. When was the last time someone called you Philip? I realized now.
No, I'm at my parents this week, so quite often.
Okay, there you go. Yeah. We also have Jorge. Jorge, how are you?
Hi Felipe. Very good, thank you.
Good stuff. James, good morning. How are you?
Yeah, very well, thanks.
And Neil Crosby. Neil, how's everything going?
Good, thanks.
Excellent. So a lot of things to discuss today. Today we're going to be focusing on light ends, crude and middle distillates, and obviously looking at what happened and what we think will happen, market calls, obviously. But maybe let's start with flat price, market situation with US-China 90-day reduction. Anyone wants to talk about that particularly, or,
Yeah, I can just set us off, but obviously the main impact in the very short term is probably more on the light ends, which is why we're going to pick that up first today. Yeah, so since last pod, there's, I guess, $5 or $6 on flat price that we've gained. And the main story was the US-China, let's say, reprieve or whatever you want to call it, for 90 days. And yeah, the most important short-term effect is the kind of China leg, where some US imports of light ends might be a bit more workable now, but on the crude side, probably TI is still shut out. So I think we can just set that aside for now. And then the other thing is the perceived boost to oil demand this year. So I wouldn't be surprised if, you start to see some of the agencies come out and reinflate some of their demand forecasts for this year based on, essentially a slightly better macro outlook. I don't know if that's going to be justified for all that long, because we've still got essentially a higher tariff burden globally, but let's just say the narrative will be a bit more bullish for the next few weeks, let's say. Jorge, I don't know if you want to pick up already some broader themes on the light ends, if you want to save that for the next section.
I think maybe we can go with the impacts of tariffs in PG, if you want to start by that.
Let's start with that. Yeah, let's talk about LPG particularly. Obviously, that was, as we discussed, that was the product that was directly impacted by sanctions. Everything else was more indirect or more like microeconomical. But so tell us what's the story with LPG right now. And obviously, I guess that it rebounded based on the new situation with China.
Yeah, exactly. We have been talking about this in 2 or 3 podcasts in the past. Right now, the situation looks like stuck in the previous tariffs. But we woke up in Europe with big news, like Neil has said, on Monday morning, and the price of LPG in the East felt that change immediately. So we saw a spike close to 8% in the plumb flat price, which was the most impacted indicator due to the tariffs. Also, we have seen a rebound in the time spreads. If you look at propane time spreads, for example, in the prompt, they are back to the previous levels. In flat price, we saw a drop. In the 2nd of April, the Liberation Day, we saw a 25% drop. And then the market has been slightly recovery. And after the big jump on Monday, the market is coming back to the previous normal. Right now, the tariffs are set at 10%. It's a 90-day stop, but I don't expect there will be like a massive hikes in tariffs after that. So we could read this as the market coming back to the previous normal. And it has a lot of impacts. So China could go to the US Gulf Coast and buy their propane and ethane mainly with low tariffs. So part of the bullish story behind Naphtha has been that, because some of the feedstock for the petrochemical crackers have to be switched to Naphtha. And right now we are coming back to the previous normal in the market.
Yeah, I mean, before we dive into specific products, on a more macro perspective, whether it's in this case LPG going back to where it was before Liberation Day, but you look at the S&P, you look at Nasdaq, everything pretty much is back to where it was, or even higher. So we went from this sort of mega surprise, extreme bearishness, the end of the world scenario to now actually, there's a pause, there's discussion, there's the UK deal. The reality is that there are no massive deals. The UK deal has tremendous amount of holes and uncertainties. There are discussions going on with China, but we're in this pause and the market is now back to where it was, waiting for the new, either confirmation or Trump going back at it again, being, I'm not satisfied with this. And we cannot exclude that. We cannot exclude the fact that he will come back and say, okay, the 3 months have come by. I don't really like at all the kind of deals that are on the table. You know what? Boom. We go at it again, and we double down, and the pause is finished. Now it's 30%, 60%, 150%, etc. So I don't think we're out of the woods yet at all.
No, I think there is a risk, and I think that the volatility is not over. But for flat prices, also for Nasdaq, of course, for propane and light ends. But yeah, I mean, right now the market is coming back to the previous normal, but we could see like big swings in the market if there are more headlines about it.
Yeah, what do you have?
No, I just wanted to say, I think it was kind of if you recall a few months ago, we had this thought that either he can be the full-blown version of the kind of extreme, let's say, macro, how do you want to call it? Like changing the world of trade and stuff like that, or the market can punish him. And I think the market ended up punishing him to an extent that he had to row back. I think I don't want to say, it's a victory for China or something like that, but I think the market was very clear that it didn't like what was going on. And that's part of the reason why we now have this rowing back of ridiculous tariffs. But we're still, I think you're right, Felipe, but it's hard to say.
I mean,
timing and all that, but.
In the same way that I'm not like personally, I wouldn't like to be buying here Nasdaq and S&P. I'm cautious about it. Is that I don't think we're out of the woods. Let's not forget it's a pause. It's a pause, and he's been very clear about it. It's like, hey, the sanctions are in play, but we're doing a pause so that you can actually discuss, come and bend the knee in front of me and do all of these things, and then we'll see. And if those actions are not good enough, then he's absolutely in a position to say, well, we just enforce them. That's the reality. So, I mean, I'm just putting in a little bit of, it just seems like this is something of the past. And in reality, we're still within the pause territory,
Yeah,
anyway.
and 90 days is a long time. Like probably, I guess US importers will kind of fill up on Chinese goods in this reprieve period, and then it kind of like delays. It like drags out the whole process of this trade war in the end.
Make your Christmas shopping now, guys.
Shine and Temu are back on the market.
If there's a special doll or something you need to buy and it's only produced in China, it's now or never.
But it is working for Trump's narrative, though, right? I mean, he's blown things up a little bit, but with a couple of words here and there, the markets are straight back to where the highest they've been this year.
Yeah.
So if he wants to claim that he's not doing any kind of long-term damage and that this is just some short-term pain that you need to go through to bring people to the table and everything will be better by the end of the end of the year, end of next year, end of his term, then it's all kind of working towards or into that narrative at least.
Okay, so let's dive in. And Jorge, we'll start with you today on light ends. So last week you had a bearish view on EBOB. Is that still the case? What's your narrative today, bearing in mind what you said last week?
Yeah, I think Phil and myself have been writing and talking about this for the last 2 weeks. The components in Europe were very cheap, and that opened the E10 blending margin. It remains open. The margin is slightly higher than last week, and we are close to see, or we could see the margin opening for 45. So that's obviously means there is pressure on EBOB, and we have been talking about it. We saw a correction on time spreads and cracks during the last days. And the second point I was highlighting last week was the threat of Singapore barrels. Because after the downtrend on East-West, Singapore was really cheap into some destinations that are not typically supplied from the East. It was very, very close in Nigeria to an MR from ARA, looking at an LR1 from Singapore. It was very competitive into Mexico, West Coast, much more than US Gulf Coast. It was competitive into some Latin American outlets like Ecuador and Colombia. Right now, the picture on that has changed a little bit because right now it's not profitable, not the best option into Latin America. And the delivery prices is more expensive into Nigeria. So it's not competitive there. So from the two various points that we highlighted, the blended margin, I think, is the one that remains stronger. And I don't know, Phil, if you have something to add.
I was just going to say, obviously, I listened to last week's podcast on Monday, and as I was listening to you talking about kind of your bearish view on EBOB and relative to both RBOB and Sing, I was seeing the market move in that direction. It was a good call, bullish east-west as well, to knock out those barrels that theoretically could have been coming in from the east into WAF or into LATAM. And I think the biggest kind of, or there was a bit of a help in the market in that Dangote, the RFCC, returned kind of unexpectedly early. So it's been out for a month or so. Everyone knew that there was going to be a planned kind of full turnaround on it in June. So I think the market was maybe assuming that actually Dangote, the RFCC, and therefore a lot of the output was going to be just offline well into the summer. So that return has been quite a bearish impact on that market in particular. It looks as though, it's knocked down the retail prices or just the wholesale price in Nigeria now, and they've pushed back that planned turnaround from June to potentially August or even later in the year. So it's giving a much more kind of bearish tinge to that East Atlantic market than we had been seeing previously.
And what about the RBOB arbitrage from ARA? What's the situation there?
So in the very prompt, that's now open again, and we've seen the move was on the paper, so it was on the TA ARB that moved to open that. Pad 1 stocks have been climbing back to kind of close to average. Refinery runs are again also kind of back to historical average range. So I think looking kind of further down the curve, the ARB is open for May arrivals, but obviously that's extremely prompt, or May loaders, sorry, but that's still very prompt now. Looking further down the curve, there is still maybe some buying opportunity for the TA ARB, but there's a risk to that. So when we're showing kind of July and August being very closed on that RBOB out of ARA, it's partly on the basis of the fact that our forward component premiums are assuming that we get back to a more kind of historical relationship between those component premiums and the underlying paper. So how wide gas NAP is, for example. But those component premiums have been really lagging. The physical market has been really lagging the paper recently. So there is a risk that it continues to do that over the next kind of couple of months, and then actually you don't need the TA ARB to widen all that much to open that RBOB again. You just have the components stay cheap, and that keeps the blend costs down and pushes those barrels across the Atlantic even without the paper necessarily.
So when I look at the trend, if you want, and whether it spreads particularly, this seems to be more of a slight correction. It's not canceling the trend, or do you feel this is canceling a trend?
I've been very much kind of saying over the last month or two that I thought we could and we should see this kind of steady improvement or steady strengthening of gasoline in general, but both EBOB and RBOB as we move through Q2 and into the summer. I'm getting less convinced about that now. The longer we go on with seeing the physical market not picking up and inventories not showing any kind of tightness, the more I think that we can actually just have a comparatively weak summer. I mean, we were never going to have a summer like we've had the last couple of years again, but maybe back to a pre-COVID type summer.
Well, yeah. Last year, don't forget that as soon as we got into July, August, everything collapsed dramatically. Yeah. So we might, that's what I'm trying to figure out, is that I'm intrigued. I'm very much intrigued with the situation because I haven't been in the podcast the last 2-3 weeks, but the story around cash dips not following the gas naphtha, not following the spreads, etc., has been a consistent story, which is basically telling you that despite potentially open ARBs or the theoretical potential of opportunities in the market, people have not been capturing them, or the volumes have been little, or but there's definitely a story here. When I look at just the chart and the trend within the chart, I see that it has not been canceled. We haven't broken that sort of trend. Looking at the spreads that came, June, July spreads going from 3 to now to 10 to almost 10 and now at 8. we're still within that trend, so definitely something to keep an eye on. Cash sits there, particularly with gas naphtha going up and all that. Something should give. Why is octane so cheap?
You ever think, just to interject, I'm looking at for example, the US gasoline imports data on a 4-week average basis. It's actually pretty low. Is that relevant to what you guys are talking about? Like the actual volume flowing to the US looks to have been lower than last year. And then the other thing I was thinking, because you've talked a couple of weeks, Phil, about deferred kind of TAR being rather weak.
Mm-hmm.
Is there anything kind of like discretionary about that? It's a good time to be short RBOB because the US macro situation was just going to deteriorate. Do you ever think on those terms?
Honestly, that to the second point, I hadn't thought about that in that respect. On the first one, I think last year the story, if I remember correctly, was that actually there wasn't that much RBOB that went into the US either. It was more just kind of heavy naphthas that moved from, and maybe some other blending components that moved from Europe rather than the finished grade. Maybe that's happening again, but it seems as though not even that's happening this time. So whether that is a demand story from the US now, maybe there's not kind of if there is a relatively bearish kind of outlook for demand or for the economy or whatever it is in the US, then it's maybe a reticence to build stocks unnecessarily in pad 1 at the moment to lock those in. So yeah, it could well be that it's those kind of deferred TAR are an expression of that. It could also just be that maybe some people they hold their component diffs flat on their forward curve, and then the ARB works even without having to move the paper.
Just so, if you remember when we had, I think it was early March, or there was this big trend of ARBs moving to the Gulf Coast, Reprieve going to Gulf Coast, F1. I think it was in February, March, people booking F1 because summer grade was so cheap in Europe that they were just basically locking in the arbitrage ahead of time. And maybe it's a consequence of that, because I'm just looking at the Reprieve chart, comparing it with the gas naphtha chart. And normally those are aligned. There is a strong correlation between the Reprieve and gas naphtha, which makes sense. And what I see here is that since early March, basically gas naphtha has rebounded from almost 40, June gas naphtha has gone from 40 to now 120, whereas Reprieve has relentlessly come down. This is like a straight line dropping like a stone, completely disregarding any kind of gas naphtha change.
No, that forward chart for the Reprieve is kind of as our forward estimate, which is obviously kind of linked to that forward gas nap, has diverged from the prompt physical reality. So Reprieve premium haven't necessarily actually fallen in the prompt, they just haven't risen as we expected to as we got closer to June. And I think when we were talking about those summer grades being locked in already in early earlier than normal in winter, we were saying that this has happened previously. By kind of late April, early May, we should have then started to churn through some of that, and we could start to see some demand picking up, kind of prompt demand picking up again for the higher octane stuff for the Reprieve, for example. We haven't seen that yet, and that's what's making me a bit nervous then about actually just the state of demand, really.
Fair enough. Look, let's just we need to move on as well, but there's definitely something that needs to be investigated there before people maintain a sort of like blind bullishness,
Yeah.
I think we need to investigate what's going on, and maybe, Jorge, if you can this week talk to some traders or brokers and understand what's missing here in the story so that we can talk about it next week. On Naphtha and LPG, we talked about LPG already. Anything you want to add as well, maybe on Naphtha, the impact of this 90 days, or you've covered it already?
No, I think there are changes also in the Naphtha market. We have seen a very strong end of Q1, beginning of Q2. Right now, the market has traded lower. And right now, I think that some of the fundamentals have changed a lot. First of all, we have the LPG story. We have talked about it already. But part of the bullishness behind Naphtha during the last month and a half has been due to LPG. And right now, you don't have this impact. So the market is less supported on that. And then, that would be like the first story, why I'm changing a little bit my view and being more bearish. The second one would be the ARB. It's very, very close to the east. At these current levels, we are not expecting to see the ARB open in the next month and a half. Then the market has been very supported on the physical side in Europe by the Med outages in Spain and Portugal, and they are coming back. This obviously impacts all the Mediterranean area and is the first one that flows to the east. So yeah, I would expect that the physical premiums that are very tight in the Med will trend lower in the coming weeks. And then the last one would be the petrochemical margins. Right now we are seeing the prices increasing for LPG and for Naphtha, for the feedstocks, but we come from a very strong downtrend in ethylene and propylene. So the margin currently are very low in the east. So if you mix all of these factors, more propane flowing into China, less has to be replaced with Naphtha. They are very close. The refineries from Med coming back online and producing more Naphtha, and the petrochemical environment, I think you have 4 points, and the market is already very strong. We have seen a correction during the last week, but if you compare the values of time spreads and crack with the seasonal values, the market is still very tight. So yeah, I think I'm changing my view on this. Last week, I talked about a possible correction in the short term, but I think right now it's becoming more structural. So most of the fundamental points that maybe these levels of time spreads and crack are too high in the medium term.
Okay, clear. Should we move on to crude? Neil, on Monday you started to feel a bit more bullish crude. Now that's something, Tell us why. Why are you suddenly a bit more bullish crude?
Well, yeah, so let's just sort of review last week, let's say. So I think last week we kind of said we wouldn't want to be short Brent spreads for a few different reasons, which I'll kind of go into again maybe. It worked out not bad this week, but it was also kind of following flat price gains, which came off the China-US basically news. So it's not really a fair win, if you like. Spreads are up though. I think I'm starting to get more bullish just from the taking a step back and thinking about the fundamentals, whereas on the ARB basis, looking at ARBs, it's kind of a non-signal for me just now. So just on the fundamentals piece, I'll just whiz through them. One of the most interesting data points for me is the US stock situation. So US crude stocks have been drawing, I would say, early and relatively strongly, and total oil, commercial oil, is also drawing, right? So including products. Doesn't kind of smack of particularly loose market. The next thing is that there has been evidence of the kind of Chinese put, if you like. So imports were rather strong in March and April, and that kind of factored in to what we might have thought. And I guess the main one for me is the kind of OPEC news, right? So been a lot of headlines, bearishness in terms of what OPEC is doing. And I think the market tends to, or certain areas of the market tend to get over eager or maybe even slightly lazy, if you like, about what this means, right? So we all know that OPEC certain members of this group have been overproducing anyway. So to an extent, it's kind of like the official target's rising to meet the actual supply. And then I'm just very doubtful about what the actual increase in exports will be over the next couple of weeks, because it could be that it's really only the Saudis that hike supply. And then we're coming into the crude burn season, we're coming into probably max run season, and we've got reports of Iraq probably wanting to reduce exports next month as part of their compensation scheme, which may or may not happen, but there's evidence that they've been doing it. So I think I'm less bearish on OPEC than parts of the market. And the other stuff is that we're coming into max run season and margins are strong. So for me, like I said last week, it's a good time to be, in theory, adding barrels to the market because this is the strongest part of the year. And the early stocks data are telling us there's not much looseness around. So I guess that's really why I'm bullish. And the other thing is Brent has definitely been another outlier. So let's say 2 to 4 weeks ago, Brent was an outlier in the other direction. It was pricing very extremely strongly. And now it's the kind of drag on the market, which doesn't necessarily make as much sense. So it's just swung to another extreme. CFDs are in contango at the very front. Having said that, it's just 40s that has been pricing extremely weakly. So again, it's kind of like I kind of discount it as a signal a little bit. In terms of ARBs, like I say, it's kind of a neutral pattern for me. I'm not quite sure what it means. There's a couple of things I'm thinking on the ARBs. So the first thing is for light sweets, they're kind of closed to the east just now, slightly. We've seen worse. And part of the issue has been that Brent spreads have been rallying into this flat price. And so we've got an EFS, which is now $1.30, which doesn't help. But I think the main thing is that we still haven't seen the start of the new Asian crude cycle. So that started basically today. And I think we need to basically watch what happens to the Dubai market for the next 7 days to understand how tight this Asian market will really be. And just a note on that, for example, the Saudi June allocations to China are basically unchanged. OSPs were raised, so I don't have any evidence to suggest they're trying to squeeze in more barrels into this market, right? So I think Dubai could end up the Dubai market could tell us a sort of tighter price situation than we see currently. And then that will help to kind of reopen the Arbs East as well. And then two other things just quickly. The one is that CPC had a particularly bad month, if you like, for Europe. So it didn't flow to Asia at all. And Kazakhstan supply is high. And so Europe had to eat all of that. But I'm also just thinking the CPC diff is actually pretty strong. And it diverged a little bit from the trends in something like Azeri. So I think to a certain extent, the CPC premiums just need to come off. And then it'll open up to the east again. And the last thing is TI. So it did look like TI was very close to Europe briefly last week. It's now more neutral. I still think it makes sense with US stocks dropping, though I would say that I'm not quite sure what TI is trying to price currently either, because there's basically contango in MEH, which is another funny signal. But I think I would also just caveat that when margins are generally good, we should probably discount a little bit the TI versus 40 signal for the time being. So like I say, it's kind of a strange pattern on ARBs. I'm not quite sure that we can say much on the basis of what ARBs are doing right now, and I think it's more up to what Dubai does next week. But on the fundamental basis, I'm basically feeling quite a bit more bullish.
Okay.
Can I ask a potentially rookie question on crude, on 40s in particular? I remember it was you actually said that obviously Grangemouth took the majority of 40s, or a lot of 40s. Is that just is there an impact there in terms of that's maybe why 40s is now pricing so cheaply, or is it bigger than that, do you think?
Well, I think the sort of buying from that, or let's say the higher 40s availabilities would have happened weeks back already, right?
Yeah.
So the announcement was Grangemouth stopping processing a couple of weeks back. I think it's the type of thing where 40s just needs to price to clear to the next buyer, which is, somewhere in Europe essentially. And don't think that 40s being particularly weak now I don't think the timing is quite right with what actually would have happened in terms of buying from Grangemouth.
Fair enough.
Any other questions on crude? Yeah, I'm trying to sort of have a rebuttal here, but you made a very compelling argument here. I really don't have much to add. Anyone here, or should we move on to middle distillates?
I suppose the only question that I had still was obviously kind of, you seem to be very or relatively convinced that buying is going to be good out of Asia for what is now going to be, I guess, the August arrivals cycle, right? And that's on the basis of decent margins. The question would have just been, how much do you think it's really going to be enough to take up the additional supply that maybe comes from the West as well? Like how long can we have an open arb into the Asia from the West on top of the additional OPEC barrels?
Yeah, well, I think I just said I'm not quite sure that the marginal addition from OPEC will be particularly high. And then you've got buying for August, as you were talking about, runs peaked in May. Obviously, I don't know what the actual balances are going to be West versus East, but my suspicion is that the market has taken for granted that there'll be, 1 million barrels a day more OPEC versus 1 quarter ago. And I don't think it's going to be anywhere near that. And then we're talking about higher runs in Europe, higher runs in the US, higher runs in Asia.
Indeed. Yeah.
I don't know where that balances out in terms of the ARBs west to east, but it just feels like this feels like a nice time to be bullish, generally speaking.
Fair.
Okay. Moving on to middle distillates then in that case. James, you want to, reviewing last week's comments, you had a general view of a slow decline of ice gas oil, heating oil moving into contango. How did that turn out, and what do you think is the situation right now?
Yeah, well, we saw ice gas oil expire at -2, the spreads on Monday. That was expire, wasn't it, on Monday? So I feel generally justified on like our generally bearish call. And actually, while I was watching you guys talk now, I was thinking back to our live video podcast in IP week. And I think then we were talking about ice gas oil spreads at about +18. So I think the general decline in the market, I think we've called correctly. As we predicted, we saw a large amount of diesel land or about to land in Europe from the US and Asia, causing that weakness that we've seen in the spreads. Although to be fair, distillate cracks globally, although just generally flat, have generally quite held up. They haven't really declined that sharply over probably the last fortnight or so. And yeah, also in fairness, I kind of expressed a bearish view on the HOGO last week, and that hasn't manifested. So just to be very clear, I did also in that podcast mention that it was important to monitor refinery outages, and we've seen like a couple in Pad 5 in the US, El Segundo, Benicia. I think there was a fire at Benicia that has lent some straight heating oil. Also, this allied with the fact that stocks, diesel stocks, distillate stocks in particularly Pad 1, Pad 2 in the US are still quite low. And those combined with each other has lent the heating oil complex quite some strength in the prompt, which has also been reflected in the HOGO that I just brought about. Although I think an important point to monitor is that we should see some damage come in the next weeks or so, as we've just started to see those Spanish refineries returning only now from the recent electricity outage caused outages in terms of stocks.
Yeah, and what about distillate cracks and spreads in the East? What's your opinion on those?
Yeah, well, we've seen those generally increase over the last period of time. And we're going to talk more about the ARBs later when we move on to the ARBs. But actually, this kind of strength has actually, over the last fortnight, has helped to open, like, for example, South Korean, North Asian ARBs into Singapore. They've been open or close to open for much of the last fortnight. And this is a fact that we've started to see in the Singapore middle distillate stocks as well, which have been rising for, I think, the last 2 or 3 weeks as well. And on top of that, we've got Asian turnarounds, actually something that Neil alluded to briefly just then, peaking right now. And we should see those runs in the Asia Pacific region increase. And the fact that refining margins there and globally are also very strong currently should only help that further.
Fair enough. And how is that shaken out in terms of diesel, jet, and jet ARBs? You know, you want to talk about ARBs. What is the impact that you're seeing right now with?
Yeah, well, that's really kind of the most important factor, I guess, really. So we've got that widening HOGO, particularly in the prompt. It shut down the US Gulf transatlantic ARB into Europe. Although, to be fair, the newly released Sparta TC14 vessel supply and demand model that Michael's been working on is looking very bearish. So we should see some come off in TC14 freights, and that should probably help to reopen this ARB in more the short to medium term anyway. And these ARBs, these US Gulf ARBs, actually should really be aimed at Latin America currently as well, because they're closed into Europe and actually open into much of Brazil, for example, currently now. And despite the fact that we've seen a slightly widening gas oil east-west, it's actually been quite a shallow move. I think it's moved from something like minus 11, 12 to minus 14 in the prompt now. So we're still seeing these Middle Eastern diesel cargoes pointing east ARB margin-wise. And if anything, actually, I think there's been a little bit of move on the freight as well. We've actually seen the margin between east versus west actually continue to widen. I think this is an important point because if we looked back maybe 6 weeks ago, we saw that these margins difference between east and west is very narrow. And I think that, and we predicted it, explained the large amount of Asian arrivals we're getting into May right now. But it's been for the last 6 weeks that this has been widening this margin. And I think we've started to see in the stock data an increasing amount of Middle Eastern diesel end up east, essentially. And also, yeah, as I highlighted before, and not to harp on about it too much, is that we've seen also South Korean, North Asian diesel ARBs also open for much of the last fortnight into Singapore as well. And yeah, just to move on a little, because I don't want to not talk about jet. We've seen Middle Eastern jet cargoes continue to point west and continue to be open into Europe and the US Atlantic coast. And it does, well, the figures bore out that jet demand currently is actually quite stellar. So it probably has the ability to swallow these extra supplies for a while. But how long that will continue will be important to monitor as well. I think that should, at some point, these extra jet supplies should put a ceiling into jet derivatives, essentially.
So how is this changing, or is it changing your view? I mean, can we see a rebound here on the market since the contango?
Yeah, well, I want to be very clear about this. I still have, if I was talking about my medium or long-term view on, distillate derivatives, it's bearish. As Neil, again, spoke about, we're seeing runs everywhere increase from here, essentially. And that's the main thing, allied with strong refining margins. So we should not really see, in the medium to long term, any issue, I think, with diesel distillate supply. But in the very short term, when we talk about kind of June derivatives, I could see a stronger argument now to probably be bullish ICE gas oil and heating oil. And essentially, that's mostly driven by the fact we've seen that the gas oil east-west not widen enough yet. We've seen the HOGO widen also in the prompt. So we've seen a real shutting down of arbs from the US and Asia into Europe. So that's the main, into the Atlantic basin, really. So that's the main thing that's shutting it down. And again, just to repeat myself, is that's only really in the prompt. In the medium to long term, I think the increasing these runs will put a ceiling in that.
Yeah, it's a tactical maybe rebound. The market did what it needed to do, bring down the spreads from the plus 18 to now a situation of contango. It maybe stabilizes here around and hovering around a certain area, but there's a small tactical rebound. Is that a good summary?
Yeah, like a neutral to bullish view in the short term, a bearish view in the medium to long term, yes. And regarding like Singapore middle distance cracks, I think it's kind of, I've probably already said it, but the increasing runs from now, the fact that we're seeing more Middle Eastern diesel we should see more Middle Eastern diesel head east, I think will put a ceiling in Singapore middle distillate cracks and spreads in the very soon horizon.
Yeah. If we finish up with some final calls and a wrap up of all the different calls, starting with you, Jorge, let's just summarize here. I think it's always useful for people to get the quick summary.
Yeah, well, I think the main indicator I have a vision right now, it's on Naphtha, but it's also linked to what we have talked about tariff and LPG. I think we have seen a very big rebound in flat prices and also in time spreads in propane. And yeah, I think we will keep seeing a recovery on that. And if you add this with the points that we have seen about the arb in Naphtha, about the refinery turnaround peaking with high margins, the med refineries in Spain and Portugal coming back online. So I think that my view for time spreads and crack on Naphtha right now, it's bearish.
Then we have the situation, the follow-up that we will do next week on this divergence between gas naphtha and cash dips, and what's the story with the cash dips in gasoline. On crude, you talked about bullishness or a stronger view in the market. How would you reflect this in a positioning? What would be the right way of expressing this bullishness?
I always get caught out by this. I guess I'll say Brent spreads, but yeah, I guess I'm more bullish Dubai than I am Brent. But yeah, I guess that's what it is. Yeah.
So it could be Dubai Brent, it can be Dubai spreads. Is that? Yeah. Okay. And on diesel,
yeah, I guess I can see an argument to buy. Yeah, it's quite a neutral view, but I can see an argument to buy June gas oil and June heating oil spreads. I guess I would be selling Singapore diesel spreads and cracks.
Yeah.
Yeah. And I guess you could also express that view by the East-West as well.
Or apply where you buy the prompt spread and sell the back spread. Yeah. Okay. Well, look, that's all for today. Thank you very much, guys. I appreciate it. It's good to be back after 3 weeks. I know you're all hoping for Rachel to come back, but we'll alternate. Anyway, good to see you guys. Thank you so much.
Thanks very much.
Cheers.
Thank you.
Cheers.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.